The Canadian dollar is already weak in comparison to the US dollar, but today we're looking to see if there is further declines on the way. We're going to be starting off by talking about what impacts the Canadian dollar, where we're at today, and where we could be going in the future. But if this is your first time here, my name's Nick and welcome to Ways to Wealth. Before we hop into the video, I have a huge favor, a huge ask. If you learn something new or you get some value out of the video, hit that like button for me. I definitely appreciate that. We drop new content every single Sunday, so make sure to come back and check it out. We're gonna start off by taking a look at the historical performance of the two currencies, and we look into Yahoo Finance here to see what the relationship looks like dating back to 2004. The first thing that we notice is that it's at the lower band of the relationship, meaning that the US dollar is worth more in comparison to the Canadian dollar, and it's trading for around 73 to 74 cents. Now, when we dive deeper and look at the past 2 years' performance, we can see that the Canadian dollar is on a downslide. And we're going to be talking a little bit today about what impacts the Canadian dollar. And these factors consist of commodities, what the Bank of Canada is doing, job creation, and how the two countries are getting along. We're going to be starting out by what the Bank of Canada is doing with its interest rates. We have a big decision coming up this week, but Tiff Macklem has already given some inclinations that we are going to be holding steady. There is a pause in potential interest rate increases. So we'll take a look at some of the reasons why Tiff has mentioned this by jumping into the CBC article here, listing the 3 reasons the Bank of Canada is set to pause. The first reason that they are set to pause is that we have seen inflation come down. It is on the downtrend. And this chart here just gives us an indication of how quick the Bank of Canada has raised its rates in conjunction with what the annual inflation target is doing. And obviously right now, if inflation is coming down, then they don't have to increase the rates anytime soon. We're kind of in a wait and see to see what the economy is doing. Which leads us to our second point, and that is GDP, which is giving us an indication of what's going on in the Canadian economy. And we can see here that GDP growth ground to a halt in the fourth quarter. It definitely came in way under what was expected at 0%. And this is something that is giving us highlights that these interest rate increases are working. It's bringing down inflation, it's slowing the economy, and let's just wait and see what the future has in store. And another important factor is the employment rate. We did get a super hot employment rate in December. And the next one for February is going to come out on Friday, which is after when the Bank of Canada is set to speak this week. And that is definitely an important data set and for them to make their next decision. So until we get those numbers, it's pretty safe to say the Bank of Canada is going to continue at 4.5% with no further increases required. Now, with that being said, Tiff Macklem has definitely made it known that this pause is conditional. He stressed the pause was conditional, however, making it clear that they will be ready to jump back in and raise rates further if the economy keeps showing signs of inflation, and especially if those job numbers stay high, because what we know is that if wage growth is there, then people can continue to buy goods, and therefore inflation may remain sticky. Later on in this article, a chief economist from CIBC, Charbonneau, went on to say that the risks are still tilted towards interest rates not being high enough, making rate hikes more likely than cuts for the foreseeable future. So there's a lot of underlying connotation right now that the Bank of Canada could cut rates at the end of the year, but this is something we've been discussing for so long, is that it's going to be higher for longer. And right now there's just not enough data for the Bank of Canada to make any predictions of where it's going. But where the interest rate discussion becomes relevant, or where it becomes important with the Canadian currency, is that if the Bank of Canada shows weakness and not being able to tame its inflation problem, then a lot of people will want to get rid of the currency, causing a selling pressure. So all of these factors that are leading into the interest rate decision is actually affecting the currency as well. So if the Bank of Canada does cut, then the Canadian dollar will fall, and I can guarantee you on that. For further confirmation, we go to this ING article that states, from a market perspective, the fact that the Bank of Canada has paused and most likely peaked naturally has negative implications for the Canadian dollar. Much like we just said, if the Bank of Canada doesn't get inflation under control using its interest rates, then there could be a further slide in the Canadian dollar. Now, with that being said, there's another important factor that controls the destiny of the Canadian dollar, and that is in commodities. Now, one of the things that I've been looking at, one of the things that has caught my interest is what is happening in China. So let's take a look at this article from Financial Post that states China has lost 41 million workers, almost the size of Germany's workforce in its entirety. Now, just to get a visual perspective of what this means, there's a chart here that shows the annual change in working population, and look at the decrease in numbers that it has there. Now, why is this important, you ask? Well, obviously China was going through lockdowns and restrictions on its economy. Those are now lifting, and the fact that the economy is expected to accelerate going through the rest of the year, meaning that the workforce will come back. Now, what does this have to do with the Canadian dollar? Well, we go to a Reuters article that is actually super bullish on the Canadian dollar, saying that it's expected to rise later in 2023 based on a more favorable global outlook. Now, from what we were just talking about, China is one of the big fundamental drivers as to why there is growing optimism. With that demand coming back, it's going to be supportive of the global economy and its pro-cyclical currencies. And this is because Canada is super rich in resources, in raw materials that China needs in order to build its products. The rapid reopening of the world's #2 economy is likely to fuel demand for its commodities produced in abundance by Canada. And this will eventually help to avoid a recession as long as it doesn't force inflation upwards, creating more interest rate hikes. The article goes on to say that central banks are starting to pause, and they think that it's going to create a bit more of a supportive economy for cyclical currencies like the loonie. And one of the ways that I get confirmation of what the commodity market has already done so far this year is by an ETF that's ticker ZMT. It's a BMO product, a global base metals. This one happens to be hedged to Canadian dollars, but the year-to-date performance has been 20% higher. So there is kind of an underlying connotation here that the economy is starting to ramp up again, and there could be a potential that Canada could benefit from this commodity boom, which could help save the Canadian dollar. With that being said, there's two different points we've made here. The first point is that there's a risk that the Bank of Canada decision could cause a further decline in the Canadian dollar. And on the flip side, the commodity boom in China could lead the Canadian dollar to appreciate. But what we're talking about is how the Canadian dollar will do in comparison to the US dollar. And right now, my thoughts is that we are going to be range bound. I think we're going to be trending in the 70s for much longer. There's nothing that's really striking my interest to see where the Canadian dollar is going to go, but we've given some highlights as to where to look, especially when we look at job growth in Canada, what the inflation rate is doing, what the Bank of Canada is doing, and more importantly, how the Chinese economy is running. Make sure you're looking at all these factors when you're making your decision. Do your own due diligence, but I think we're going to be in this area for longer and potentially could see a little bit of a further decline, but right in this range bound area for the rest of 2023. But if you're still here with me, if you're still enjoying the video, please don't forget to hit that subscribe button. I hope you all have a great week in the markets. Happy trading.